In this video, we're going to be looking at some of the issues related to life insurance. What are the different types of life insurance, and what are some of the considerations that go into determining what the appropriate amount of life insurance will be and what type you should get for yourself. We start by looking at what is life insurance. Life insurance is designed to support family members and other dependents in the case of your death. That is, if you are providing financially for people who rely on your income, then you're going to want to have life insurance to make sure that if you were to die unexpectedly, they would still be able to be taken care of financially. The whole purpose is to protect those who you care about from your lost income. The goal is to have between 10 and 12 times your annual income in life insurance coverage. That way you have enough money to meet all of the various needs of your family. It could be future college costs, it could be paying off your house, it could be paying off any other loans that you may have had. Having less than this amount of coverage exposes your family to some long-term risk. Having 10 to 12 should be enough to meet all of their financial needs until they're able to what we call self-insure or develop enough resources on their own to make do without your income. How much you need will depend on your circumstances and will change over time, and so you need to constantly be reevaluating your insurance plan to make sure that you have enough coverage given the number of dependents you have or debts or any of those other kinds of circumstances.
There are many factors to consider when calculating life insurance. Marital status, dependents, earnings of each spouse, how much time you have left to work, and debts. These factors change, so it would be wise to consult a trusted financial planner before making any decisions. But the main thing to keep in mind is the amount of life insurance must be enough to replace the earnings power of the deceased for those that depend on them. Buying life insurance doesn't make sense for everyone. If you have no dependents and enough assets to cover your debts and the cost of dying, funeral, estate lawyers' fees, etc., then insurance is an unnecessary cost for you. If you do have dependents, but you have enough assets to provide for them after your death, investments, trusts, etc., then you do not need life insurance. However, if you have dependents, especially if you are the primary provider, or significant debts that outweigh your assets, then you likely will need insurance so that your dependents are looked after if something happens to you. Let's imagine a simplified example of replacement income. Amy earns $50,000 per year and is the sole earner for her husband Bob and child, and they have no debts. If Amy passed away, the household income would go to zero. Bob would then need to find a job and take care of his child. So to replace most of her income and leave her family provided for, Amy would need about $750,000 in life insurance. That money could be invested at around 5% and drawn down monthly over 30 years, so Bob could have about $45,000 per year income. Add $10,000 for funeral costs and an adjustment for inflation, and Amy needs approximately $900,000 to $975,000 of insurance on herself. Every situation will be different. For example, Bob could find a job in a couple of years, or their child might need more money for college. These unique situations require the advice of a registered financial planner who can make sure your needs are accounted for. They can calculate an estimate of what coverage you need and can speculate on potential interest rates, taxes, and inflation.
So if we look at a couple of different examples, we can see, for example, if we ask ourselves, does Patrick need life insurance? An 18-year-old who's single with no children and no debt probably doesn't need life insurance because he has nobody relying on his income and therefore no need to purchase an insurance policy. Andrew, on the other hand, in his situation, early 40s, married with 3 children under the age of 18 and a home mortgage, he would need a life insurance policy because his children are going to be relying on his income. His wife relies on his income. They need to pay off the home and educate the kids. And if he were to die in the next day or year or a couple of years from now, they wouldn't have enough income to support all of their needs. And so having life insurance would protect them. At $100,000 per year, he would need a policy of about $1 million to $1.2 million in order to keep his family adequately covered. Jean is sort of an in-between. In her late 70s, she's married, so there is someone relying on income or at least services that she's providing as far as maybe meals or keeping the house or something like that. They've got children, but they're no longer dependent on her income. She does have a mortgage, so it is possible that she would need life insurance if she were to die, but at 70, you may not need life insurance because you may have accumulated enough savings and investments that you are what we call self-insured, that they have enough resources available to them that they can pay for whatever they need to without relying on a life insurance policy to help make the bills get paid. So she's sort of an in-between, just sort of depends on her situation. When it comes to what type of life insurance to purchase, you have two choices. One is called temporary, sometimes referred to as term life insurance, and then permanent, which is sometimes called cash value. You may also see the terms universal or whole life or variable life. They're all basically the same in terms of being permanent in nature. Term insurance is temporary in that it is set for a short period of time, usually 20 or 30 years maximum. And during that time, if you die, your beneficiaries, the people who receive the money from your life insurance policy, will receive money. If you don't die during the term, they will not receive any money. Because it's not guaranteed that you're going to die during the term of the insurance, in fact, the odds are pretty low that you will, the premiums tend to be very inexpensive. The downside is you're not building up equity in anything. You're not saving money towards some sort of investment. And so those premium payments are essentially lost if you don't die. That's sort of the downside. The plus side is you're still alive. So you have to take that into consideration. Permanent or cash value life insurance is different. That's there to cover you for your whole life. So whenever you start the policy until the day you die, you're covered, whether it's 20 years, 30 years, 50 years from now. But because you're being covered for your whole life and death is a certainty, the insurance companies will charge you a significantly higher premium to make sure that their costs are covered for when you do die and they have to pay out. You can choose to cancel your cash value policy before you die. There is a savings part of your premium. Part of your premium goes towards savings and investments, and the insurance company generally gives you a guaranteed rate of return. And so you could actually get money out of your life insurance policy before you die if you want. There are some negative side effects of that because you're no longer covered with life insurance, and some of the returns may not be as good as you could get on your own, but there is in fact some savings there if that's what you want. Again, with permanent life insurance, you have whole, universal, or variable. They're all basically the same thing. They all generally come with a savings component to your premium. If we're to compare the situations, we could look at a permanent or whole life insurance situation, and we could say that they're very expensive, generally much more expensive than term. If you look at an example like this, based on actual quotes, you'd find that a $250,000 whole life insurance policy cost about $178 per month. And as long as you keep that whole life insurance coverage, your family will receive $250,000 upon your death. If you choose to cancel the insurance policy, then there is a savings component that's built in. At the age of 50, it'd be worth about $34,483. If you waited until you were age 70, having watched it double a few times based on the rule of 72 that we talked about earlier, you'd have about $124,000 in savings that you could take that cash instead of the insurance policy so that you don't have to wait to die to give your family money. But you could do what's called term insurance, and there are some significant differences. If you got $250,000 in term coverage over 20 years, the cost is very, very low relative to whole life because, again, they don't expect you to die during the term. So all your premiums are expected to basically go towards paying to somebody else and not to you. So the insurance premium is only $13 a month, which is good for you because not only is it less expensive, but it frees up about $165 that you could choose to invest in some sort of stock, bond, or mutual fund. Because you were willing to pay $178 a month for the whole life, we can see what that same amount of money would do for us financially with a term insurance policy. With term insurance, we could then take that $165 and invest it in various investments, and at the age of 50, it could be worth as much as $164,000. And by age 70, it could be worth as much as $1.9 million. The difference between term and whole life is if you die in a whole life situation, your family gets the $250,000 and generally forfeits the savings. With term insurance, if you die, your family would get the $250,000 that is owed to you if you die during the term, and they get the cash value. If you don't die, which is probably the ideal situation, they don't get the $250,000 in term insurance, but they still get to keep your cash value, which is going to be significantly higher than what you'll get from the insurance company based on a whole life policy. And if you wanted to really protect your family, you could go as high as a $500,000 20-year term insurance policy, which would give even more protection in case you died. But it won't actually cost your family very much, only another $8 per month on average, which still leaves plenty of money to invest, which will allow you to leave a significant amount of money to your family when you do, in fact, pass on. The policy you choose and what's right for you is sort of dependent on your circumstances, and so the best advice is to always talk to a professional insurance agent to see what fits best with you and your family.